Time for Chart Attack, and a couple of charts we hope will make you a little bit smarter, maybe even make you a little bit money. We're talking oil, Persian Perrier, and Jason, you are a Bloomberg best on oil for your accuracy in forecasting future prices. And you are bullish on oil, especially on a relative basis. Why don't you explain to the viewers what that means?
Well, you know, there's a couple of things. I think, first of all, there are a couple of things driving oil prices higher. I'm much more bullish on WTI than I am on Brent. You know, there are two benchmarks
Brent, which is
out
the
there.
North Sea.
Brent is
oil.
the North Sea price. It's really become the global benchmark. Even the EIA has said, finally, that that's really a better benchmark to watch. But WTI is what we normally talk about here in the States. It's what we've thought of for many, many years, decades, as the benchmark. And it's fallen out of favor, but that price is what's going to go up.
All right, Sam, let's bring in the camera, and just so everyone's on the same page here, Brent, which is the North Sea crude. Anyone in the world can pull up a tanker to the North Sea terminal at Sullivan, fill her up, whereas WTI is landlocked in Oklahoma, and of course that is the yellow line. That's what we're looking at. So, Jason, when you look at this spread between the two, why the decoupling here over the past couple of years?
Well, you know, the decoupling really has been, as you pointed out, the fact that WTI has become bottlenecked. The supplies are effectively stuck at Cushing, and that's become a big problem. Really, it's that WTI is disconnected from the rest of the world, and most other crude grades are trading off of a differential of Brent, including grades that trade on the Gulf Coast in Texas. They're actually trading off of differentials of Brent, not WTI.
So you are bullish. Explain why you're bullish, why you think that gap is going to narrow.
Absolutely, and that's what we've got up here in the chart is this gap. Part of the reason we think that this gap is going to go away is because the supplies
In other words, now we're showing,
it's
the same lines, now we're just showing the single spread between the two.
That's
and you
right.
think that this spread is going to fall because WTI will rise relative to Brent?
Absolutely. What you're seeing is you've got the Seaway pipeline, which is going to allow the barrels to flow into the Gulf Coast. It opens up that bottleneck.
From Cushing, Oklahoma.
From Cushing, Oklahoma. And when you've got a trapped market, you don't have the ability to really tap a global arbitrage. When it opens up, you're basically letting it flow again, and eventually that price will come down. We expect a differential of $2 only next year, whereas we've been trading $10, $20 plus ranges for some time.
So buy WTI, sell Brent, that would be your trade and the way to play it.
I actually wouldn't say sell Brent, because I also think Brent's going to go up, but not as much as WTI.
So just buy WTI.
Buy WTI, that would be the play there.
There you have it.